What is volatility in student investing? Imagine riding a roller coaster that suddenly jerks up and down without warning. That's kind of what investing can feel like sometimes. When you start investing, you might notice that the value of your investments can change a lot in a short period. That's because of something called volatility. Volatility describes how much and how quickly the price of an investment moves over time. If the price jumps around a lot in a short span, it has high volatility. If it stays pretty steady, it has low volatility. Think of it like a boat on choppy water versus a calm lake. The choppy water makes the boat bounce around a lot, just like high volatility investments do. Calm water means less movement, similar to low volatility investments. Understanding volatility helps you see how risky an investment might be. Investments with high volatility can give you the chance to make big gains, but they also come with the risk of big losses. On the other hand, investments with low volatility tend to change in value more slowly and predictably, which can be safer for short-term goals. For students, this idea is important because it helps you choose investments that match your goals and comfort level. If you are saving for something soon, like a new phone or a trip next summer, you might want low volatility investments so your money doesn't drop in value when you need it. But if you're saving for college or a future career, you might be okay with higher volatility because you have more time to recover from any dips. Volatility is often measured using something called standard deviation. This is a fancy term that shows how much an investment's returns can vary from its average return. You don't need to do the math yourself, but knowing that professionals use these tools can help you understand how risk is assessed. It's normal for investments to go up and down every day. Sometimes the swings are sharp, and sometimes they are small. News headlines often focus on big drops, but volatility includes both rises and falls. Learning to expect these changes can help you stay calm and avoid making impulsive decisions based on short-term market moves. Different types of investments have different levels of volatility. Cash and savings accounts are very stable with almost no swings. Stocks, especially those of newer or smaller companies, can be much more unpredictable. Bonds usually fall somewhere in the middle. As you build your investment plan, mixing these types can help balance your overall risk and match your goals. For beginners, it's smart to start with investments that have lower volatility. As you learn more and gain confidence, you can consider adding some higher volatility options. Watching how your investments perform over time, without reacting to every little change, is a good habit to develop early on. In the end, volatility is a way to measure how much an investment's price can change. Knowing what it means and how it affects your money can help you make smarter choices. When you understand that some investments can swing more than others, you can pick the right ones for your goals and comfort level. That way, investing becomes less about fear and more about building your future steadily.